Well, after the carnage of the Fed yesterday, we can take a snapshot, and it didn't get much better today, but it definitely tells us a story. Usually after these kinds of events, there's usually another leg down. What you like to see with these is you want to see the gap down the next day, and then what we call the flush, and then from that flush, you want to see then the rebound. That's not what you got. Actually, what you got is pretty much as bad as you could see. It's actually worse than gapping down, because what you're getting is just lethargic action, meaning they tried to rally and then the rally fails and then you go sideways here. And the sideways action really is the worst part of it, because the sideways action is just leading to confusion and luring people in. And we could see this all day today. We'll give you an example in a little bit. But from when Jay Powell just absolutely torched the market, not so much the fact that they raised PCE, which we will show in a little bit here, but also just his statements were just absolute dumpster fires. And we're not going to rehash all of it because we went over it last night. But I do think that we need to look at some of this and determine what we're going to do with it. Like what do you do with this data that you have today? What do you do with the action today? And what I would say is this action created more uncertainty than certainty. And frankly, I wish that wasn't the case, but it is what it is. And this is the hand we're dealt. So let's jump into it. Sometimes a duck's just a duck, and you really don't have to get too more complicated than that. And here's your opening price on the futures market, and then you just kept hitting here over and over again. So nothing really to overthink there. If we mark off the high from that level, you can see how we tried to rally up, complete Matumboed, fell back down, rallied again and again, right? From there, that kind of behavior is exactly what you want to see if you're short. Other than that, you don't want to see that. What you're really seeing here is those test, retests, and you can't get through. Now, even these little levels, and we'll zoom in on this, that you're trying to hold, you're barely holding on there. And we could say, well, it's because of this, or it's light volume, we're going into the Christmas season. We can always find an excuse, and we can always find a reason to believe what we want. The bottom line is you just have to follow your process. And when you see the inability of us to rally at all, it certainly becomes an issue. And our inability to get through anything is a problem. Now, did we take out those lows? No. And frankly, I would rather have taken out the lows, done the flush, and moved on, because now you're in this kind of spiral. And once you see it, it really just becomes that issue. Now, if we come here to where we got JPOW and just look at it from that perspective, right? And then we blow this up and say, okay, well, it's an H. So let's say that it's an H down to here. We haven't even gotten to that part where you've retested the level yet. So that's the first thing that has to happen before you can even think that you're going to have some kind of bottom, some miraculous bottom. You need to test that level. We couldn't even get there today. So that means that we still have some lethargy out there and some hopers and some dreamers. And we really want to watch the hopers and the dreamers more than anything else, right? We don't really care if people are hoping and dreaming, as long as it doesn't interfere with us and our lives. And right now it is. So when you mark off this H or whatever crazy pattern you want to call that, if you just take it to this neckline, and I think you're better off doing that for now, taking to the neckline, that gets you 1% down. From here, that can go a lot lower, like a lot lower. So you could break this, go down, and then you're looking at these measured moves. And this is where it gets super complicated, because what you would do is you would take the fib of this level, I'll show you how to measure, and you're measuring this down. So you take it from 0 to here, and you get the target price based upon that movement. So what I've done is you just go 0, and then you put the 1 in, and really all you're going to get is the same exact thing. And I'll just show you by putting all the fibs in. You're going to get the fib levels to the downside. And what you're doing is you're going to get that target right here. And that's going to take you to that 57.37. And all I've done is just take the measured move. And that measured move from there, it's a problem. Now, if you said, well, let's take the measured move from just when we got JPOW, and we'll put that right there, to where the carnage ended, it still gets you to that 57.51 area. So you're still down here. Now, if you took that, and then you looked at this on the hourly and said, okay, well, what's down there? And it kind of takes you this little level here where you were November 1st. So really what this is telling you is the targeted move of all of this is right back to when? The election. I thought that was kind of interesting, and I wanted to share it, because all we've done is measure the fib from that move where we got JPOW, and we're looking at the H for like that kind of area where you could get, but the whole measured move is 57.51. Now, if we clean all this off, just to make it super simple, go back to the daily chart and say, okay, well, where does that put us? And it puts you right on the support level. Now, the question with this really is, are we going to get here before we see some kind of bounce? I don't have an answer to that because you have the volume that's going on. You have quad witching tomorrow, and then you go into the holiday season. So do you have light volume or do you see repositioning? What I will say is this particular pattern, the fact that you're down, unable to rally at all, and that close, and this is really important for people to get. Looking at this close, you would go over here and you can just see the numbers. If that close is exactly where it is, which it is, 59.06, okay, 50, and then you come here and you see our close, right, 59.43, you don't want that. You don't want them near each other. You really don't, because what it means is whoever's here is still there. Now, it might be off a little bit, and you could say to yourself, oh, it's a little higher, but it's like trying to put lipstick on a pig and say it's not a pig. It's still a pig. So you kind of have to watch that there, and you have to be super careful here. Now, again, do the simple things, overlay the moving averages, and we're going to say, but we've got the 55 there. For how long? Remember, I used the 12, the 22, the 55. And you can see the volume spike. So is that enough? I think that this is where it gets super dangerous. And by dangerous, I'll tell you how. I think that people convince themselves that they're going to, because they're oversold, that they're going to get the bounce. But what I'm seeing is I'm seeing them take advantage and sell into those bounces. But take a look at the breadth and we'll go from there. Now, when we talk about breadth of the market, what we're really talking about is how strong the entire market is or is not. And a couple of things that I like to look at are stocks above certain levels. They tell us correspondingly where we were when we had these turnarounds. And if we just take a look, we're going to go over what exactly these levels all have in common. And here we are, number 4. But what I used to show, or what I like to show, is I show them all together up here, where I'll show you how we can see the stocks above the 5, the 20, the 50, and the 200. But what I did was I just created this chart, and what you'll see is, so these are the 5 below. So S&P stocks above the 5-day moving average right now are sitting at a 3. So if we do the simplest of things and just grab a line and drop it, what you'll note is the behavior of these moves is very similar to this behavior that we're seeing now. And what I tend to do is go through it, and I'm just looking to add more levels. In other words, I'm looking to see, okay, great, we have the 5 days that they're lined up. And then if we take a look at the 20, which is where we are right now, what you're going to see is you're going to get more data that solidify that, hey, maybe we are oversold, and this will obviously fall in line. This is obviously even worse and has way worse oversold than we were here. We take a look here, you're right in line, and then you can see obviously you were right in line here before, and then you can see here as well. So you're going to get some more data points, but the ones that I did originally, and I'm going to do others, but the ones that I did originally, they were the ones that were all lined up with everything. In other words, the 5, the 20, the 50, the 200. So then when you get to the 50 and you drop it, you're going to get less, not more. You're going to get more in tune, in my opinion, with the 20 and the 50 are going to be more in tune than the 5. Obviously, because this is short term. And then you would go, longer term, and then you would go institutional kind of level. And they do look at this. Institutions do look at this. As soon as you break 50, they're pretty much risk off in general until you get back above it. And then you'll tend to see that everybody kind of piles in. They're like lemmings when it starts to happen. And then, of course, you have names that are at the 200. And if we just do the same thing and drop from here over, you're going to see on the long-term chart, you're not really anywhere where you were in October. But you look at some of these other levels and you're in line. But there's others that could get a lot worse. So what is this really telling us? It's telling us in the short and medium term, we are really in a position here where we need to watch and understand that we could have a short or medium term bounce, but longer term, it could get worse. Now, whether or not it does totally remains to be seen. I don't know that we have an answer to this yet, but on the breadth side, could you bounce here? Could you see some kind of rally into the end of the year? Technically, you're pretty oversold. When you get to a level where only 3% of all S&P 500 stocks are above their 5-day moving average, it's not a lot. I mean, it's really not a lot. So you're so oversold that you're due for something. 92% of them right now, if you take a look right here, are below. 92% of names are below their 20-day moving average. And 80%, actually 82%, are currently below their 50-day moving average. So that is a pretty trough level. And when you look at it, you can see these levels from October 22nd, March 23rd, and I'm just using the year ends, and October 23rd in here. So what does this tell us? Well, between that and the advanced decline line being 9-1 yesterday, you moved pretty viciously. So can we see some kind of short-term bounce or relief here? The answer is yes, you could. Can it always get worse? I'm not really sure what we're going to see into this weekend with the 1 day left, But I do think that this is worth paying attention to, especially going into the end of the year and certainly going into next week. People are going to look at that. And they'll be repositioning for their tax selling and tax buying. And we'll go over some of that on Saturday and how that works out. So make sure you subscribe to the channel and click all notifications. Now, when we see the breadth and we talk like that, we can look at those levels and understand where we've been, and then we can figure out what to do with it. What I would do is start looking at some of the leading areas where we've made money. Obviously, a lot of people have made money in Bitcoin. You are closing below the 22 for the first time today, and that's significant. Now, the significance of this, to me, a lot of people say, well, we've broken it here, we've broken it there. The significance of this to me is that this was the day where we said, okay, no, we're really going to close below it. You kind of did in here, but you rode the line, flipped it the next day with a new all-time high close, rallied up. So to me, this is our first one. Now, can we get back above it? Maybe, but then we overlay this with the volume, and you can see the volume's increasing. Overlay it here and look at this little beauty. So for those that are newer, this is a 8, a 5, and a 3-day moving average cut out over a 6.5 hour time frame. I understand Bitcoin doesn't trade that way, but I trade the same time frame as the New York Stock Exchange hours. It just works for me in my head. But what you're seeing is you're seeing that flip from 853 here. You didn't have that flip before, right? Now, when you broke those levels, you didn't really have that. You're having it expand. Look at the way that this was pointing down when it happened. Look at how this is pointing down. It's a very different trajectory right now. And a matter of fact, the other thing that you would take a note of, or I think you should take note of, is the following. When you got here to that 5-day moving average today, what did you do? You completely rejected that area. So if you were looking to short any of the MSTR names or you're short any coin names, you're into a 5-day moving average that's declining and the 8's above it. So it's pretty much perfect, right? So you already know that you have weakness and you already know that it's rejected in here. And now that you're positioned correctly to take advantage of that. So this is where we would start putting on hedges. I'll show you how in a moment. But what I'm trying to do with this kind of environment, when I look at something like Bitcoin or I look at the NQ, is I have to realize that this can get way worse than you think it can. I've been around a while, so I've seen this story before, and nobody thinks that it's going to happen, that they're not going to get that 5 or 10% down day. But there's no Fed put anymore, and this Trump put is pretty much delusion that you're going to have a put on the market before a guy's even in the office. If anything, I think he's added to the exacerbation of the move. Just because of what you're seeing with the government spending bill and what's going on there right now. But nonetheless, what you're seeing here with the NQ is that you did make a lower low close, but you're still in that bar. But for this to have more follow through wouldn't be that shocking to come down to something like this. So what I like to do is I look for what the high flyers are, and then I take those high flyers, like the really big high flyers, and then I will put positions on, usually 10% down, towards the end of a specific time, like the end of the year. So today, what we did was Tesla puts, and then we did MSTR puts. And what we're doing is we're doing them 10% away from the market. Now, what this does is it gives us a lot of leeway because we're going out so far and you have so much time that they're actually cheaper even with the move down. So let me give you an example. Now, in front of you are just some, when I'm live trading, John will type, but there's the timestamp so you can see what we're doing. So what I'm doing is I'm going out there and I'm buying the 300 puts and I'm going as far out as I possibly can, out to 27. And what this is doing for me is it's just giving me a lot of freedom, a lot of movement, and I can buy them really cheap. And what I'm looking for really is, I almost refer to them as gamma trades, because what you're looking for are those big moves down that people get nervous, right? Then they go out and buy those. So we want to get ahead of those. We actually shorted NVIDIA here, did okay with it. But Tesla, we bought these puts, same thing. And what I'm doing is I'm putting small positions on. So when I'm doing these kinds of like, quote, put hedges, what I'm looking for is I'm looking to make 5 to 1, 6 to 1, things like that. I'm not looking for 50%. Now, if it happens fast, like here, it happened in like 5 minutes, I'm up 50%. I'm like, okay, I'll take something off there because it's so silly to be up that much so fast. But really what I was looking for here and what we wound up with was we did get some doubles and triples and did very well with them, but it didn't have to be today. The purpose of doing these is to put these trades on and then leave them on. Here, take a look. I'm taking things like MSTR right now, and I'm buying the 300 puts. I'm doing it right now as we're talking. They are so out of the money. I paid $1 for them. I have No stop on those points. Don't ask me about it. Don't talk to me about it. They are my hedges that are going to be out there. MSTR can go to 400. That's great. Doesn't matter to me. It's a 1% position, but I want to get something off so that if this does get bad, I've got hedges. Low a day, up a little bit on those puts, but not doing anything with them, just leaving them alone. We're up 50% on MSTR. I'm not really doing this for 15% or 50%. I'm doing it for 500, 600%. If you're doing this for the trade to make like 50%, you probably want to trim some. The MSTR trade right now, you're up about 100% on. I trimmed a little bit of it. I have a ton of them. I have to trim when I can. And that's your first target right here. And you're pretty much there and you're bouncing. I trimmed about 20%. That's why you do it. This is going to work. Sold some. Up 200%. Again, this can go all the way against me. I don't care if it goes to zero. Just understand where my head is with this. If I was worried, I would just move the stops. I would make sure I pulled money out. Just wait from the break even. You get stopped at a break even. Who cares? You made money. Next. Now, the goal is to try and stay in moves like this. Now, whether or not we're going to be able to remains to be seen, obviously, right? But those kinds of hedge, when you leave them on, you're trying to get that, 5x or 8x, like what I refer to as a long tail return. I'm not interested in just, okay, well, we made a little money. You're trying to hit. You're not trying to do that with every single trade. You just have to size accordingly on those kinds of positions. But to get back down here to that 55 and touch it, and maybe even break it, if somebody said that was going to happen, they'd say never. And here you are looking at VST, and that broke. VRT, that broke. These are leading names, and they're breaking down. We did have some strength, but this is the most troubling thing. Make sure you watch Saturday's video because we're going to get into the equity risk premium and where the real problem lies with this. That conference yesterday literally was one of the worst conferences I've ever heard. I think it went on record as probably, I think it was 0.1 that they said it was worse than that as far as a percentage drop. But I don't think we've ever lost 1.8 or 1.7 trillion was the final total, something like that, off of Fed speech. I mean, it was awful. There was no clarity on why he did what he did. No one really understood why he cut rates. Him referring to him being in a situation where he feels like he's in a dark room with furniture that he doesn't know where it is. Didn't make anybody comfortable at all. Just some of his comments were just off the wall, and he looked really irritated and really annoyed. But what I care about is this 450, because everybody's a little afraid right now. I'm going to show you why. Now, every quarter they come out with a dot plot. And the dot plot in and of itself is not a bad thing. It's not something that we should be concerned about, and it's certainly not a bad thing at all. Now, when they come out with these dot plots, over time, it's like every government agency, they just come out and do more and more on the dot plot. So not only do they just plot, now they tell you where they think GDP is going to be and everything else. It's silly, and they should have stopped doing it. They did it during Bernanke. I understand then why they did it during Bernanke, because there was so much chaos. But here, very quietly, here's the PCE inflation. Now, despite the fact that he cut rates, couldn't give an answer for it. Despite that he did all that. Couldn't answer that, couldn't say why they did what they did. They're worried. Some people put in their economic projections, policies that may or may not get approved. Despite all that, here's PCE inflation. Here's the median on how they voted. It tells you September and where they're at. So you're supposed to watch this and see where they're going. Unemployment is going down, which is great. They have PCE going higher, and they have core PCE inflation going higher. So the whole mass is saying that, based upon the dot plot, that they're going to cut rates. So they're cutting rates into inflation projections by them going higher. This is beyond batty, like just beyond. There's literally probably no other time where you could look at this plot and say they're cutting into inflation going higher. And this becomes a real issue. So the lack of credibility yesterday was pretty significant, and that's why it was so vicious. Now, I don't know the rationale or the reason for doing this, and I would imagine at some time when he has one of his 47 conferences, which he seems to love, that he explains it. But we have this as an overhang right now, and all they did was just get out of the way and sell bonds. And you saw it on the 10-year, you saw it on the 20, and even today. Like, just to be clear, people are talking about the economic data that came out today. The reason that you're down is because everyone had time to actually process just how batty this was. And that puts us as traders in a tough spot, because you see that we're oversold and you're going in the quad witching, but you really don't know how people are going to act. We keep waiting for the Santa rally. but I don't know. It's starting to look more like a Grinch. That's it.